Good afternoon, everybody, and welcome to this week's weekly education session for Wednesday, the 8th of July 2015. The topic for this week is market risk changes, and I think it's a fairly appropriate topic because the markets have become fairly volatile of late. Certainly our Australian market has been extremely volatile, moving up and down in both directions, big up days, big down days. The S&P 1500, S&P 500 certainly starting to move around a little bit, and it's no wonder given the the global climate at this point in time, with things going on over in the Eurozone with Greece, things happening in China that are keeping us certainly well on our toes, keeping an eye over there, with their government trying to support their local market. All sorts of news coming out of China, whether it's true or whether it's not. Supposedly hearsay that only the best companies in China list on the US market, and those that perhaps have something to hide list on their own market. Not too sure whether that's true or not, but certainly may account for some of the volatility in that particular market. All right, let's get underway. First and foremost, the disclaimer: as always, the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, or particular needs. So before making any investment decisions based on the general advice presented in any of our presentations, please consider whether it is appropriate in light of your financial circumstances. All right, the agenda for today: to have a good, honest look at market risk for the medium-term portfolio. So just what we'll do is we'll go through and we'll recap on what the current market risk model is, a little bit of a look at how that relates to the benchmark, and importantly, I think how that relates to the value at risk that we need to be monitoring across our portfolio. Now, I think certainly the best things in trading and investing that enable you to keep performing at your ultimate is to keep things simple. Simple is always better. So we don't want to get too complicated about our trade management practices, because if our trade management practices are difficult and complex, and if there's any loose or any weak link in the chain, then I think you'll find that it all comes undone when the road becomes bumpy. And so certainly keeping things simple means that it doesn't mean that anything's going to be any less effective. It just means that we're much more likely to follow our trade parameters. And then we're going to end up with a bit of a summary at the end, which I hope will provide a little bit of, or shine a bit of a light on the way that you handle those market risk changes in your own portfolios. So let's go through and have a look. So currently, as it stands, our portfolio management market risk indicator, if you like, is a stochastic that we use in Beyond Charts. And this stochastic is just an oscillator, and it moves up and down depending on what the price is doing in the benchmark index. So whether that's the S&P 1500, the S&P 500, our ASX 200 as examples. So typically when that oscillator moves above 80 and is between 80 and 100, it's telling us that we're in a low risk market environment. As it starts to wiggle its way down below 80 and between 60, we are basically saying that, look, the market has come off its highs, it's having a bit of a pause, and so therefore we're giving it a classification of a moderate risk rating. As that index starts to fall further down below 60 but still above 40, we're starting to move into what we would describe as higher risk territory. Now, it doesn't mean that the market's going to fall away to zero. It just means that in all likelihood, the chances are increasing that the market could move, perhaps the chances of a move quickly to the downside start to increase when we get down to those particular levels. And you've only got to look back at your Beyond Charts, and you'll see that over many occasions that once we get down below 60, that the propensity for those sharp sell-offs after that start to increase. Then as we move down below 40, between 40 and 20, we're describing the market as very high risk, and then anything below 20 is extreme. So the way that we need to use this data is to think about what our portfolio management rules describe for us. Now, in each of our trading plans, we have, to start with, we have what's described as a maximum drawdown, or in another way of saying that is your maximum value at risk that you are allowed to have on the table during a low risk market. Now, for most of us, that's around about 15%. So if you had $100,000 in your portfolio, that would mean that you're allowed to have around $15,000 as value at risk exposed into the market. So if all your trades that were open during that particular market conditions, a low risk market, if they all happen to be stopped out one after the other on the very next day after you got in, then you would lose a maximum of $15,000. That is your 15% value at risk. And that'd be a terrible thing to happen. The chances of that are very slim, but we still have to prepare for the worst case scenario. So we always give ourselves a limit, a maximum drawdown before we stop trading. So then as markets deteriorate and that stochastic moves down below 80, we have to then start thinking about, well, what are we going to do with that portfolio value at risk? Now, as market conditions deteriorate, it makes sense for us to keep an eye on our current value at risk. It's a little bit like when you're driving down the road. If you notice that the conditions are starting to deteriorate, i.e. it starts to rain, it's starting to get very, very dark, the road surface goes from bitumen to gravel, etc., that you'd be silly to keep driving at the same speed that you were when those driving conditions were good. And it's exactly the same principle that we need to think about when we're managing our portfolio. So we need to keep an eye on things and just be mindful of what's actually going on in the market, because at the end of the day, the number one rule for us is protection of capital. Now, it doesn't sound terribly sexy. You know, the main rule for your investing is protection of capital, but you can go back over a long, long period of time, and just by protecting your capital and being out of those markets that certainly deteriorate to a large extent, like GFC type markets, and we've had a number of those. You've only got to look at your benchmark indicators, the S&P 500. Whilst it was terrible during the GFC, it was also terrible during the mid-90s as well. Big decline there. We had big declines in the NASDAQ in 2000. We had big declines in our own market, not just the GFC, but 2011 as well. And part of your model for outperforming is just making sure you don't participate fully in those downward markets. And that's where a lot of your trade management and use of protective stops is going to serve you very, very well indeed. So the theory is here that as market risk continues to move more to the downside, then what we do is we start to apply a market risk multiplier to our initial established value at risk. So when we're all starting off with around about 15% value at risk, if we get into a moderate market, then we need to apply that 80% market risk multiplier to our 15%, and as a result that gives us an allowable 12% value at risk limit. Obviously, as market conditions deteriorate and we go into a higher risk market and very high and extreme, we apply different levels of market risk multipliers. So you'll see that between 80 or between moderate and high, there's a fairly big jump, because we move from an 80% market risk multiplier to a 40% market risk multiplier. So we're halving, if you like, the amount of value at risk that we've got in the market between those two levels, between moderate and high. And as a result, if we started off with our 15, we go to moderate, we're looking to reduce our value at risk, and then once we get into high, we're looking to reduce it even further. We eventually move down into very high and even extreme. So what this model is suggesting, that the worse the market conditions get, the more we try and reduce our exposure in the markets, and that's what we're going to talk about today, how we can actually go about doing this in a sensible, simple manner. All right, so some of the things that we need to be thinking about, what are our options when market risk deteriorates? And I'm going to bring up Beyond Charts in a moment and go through some particular examples. But I think it's important that you, again, think about your own investing and make sure that you're extremely comfortable with what you need to do and what your rules should be when market risk changes. And that means not just changing from the good side to the bad side, but once market conditions get to the point where we really don't want to be in the market, what's our barometer, or how do we know when to get back into those markets so we don't miss out on the recoveries? And it's a pretty clear fact that even after the GFC, that a lot of investors, particularly mum and dads out there, were too scared to get back into the market. And you might remember that sort of halfway through 2009, our market really took off to the upside very, very substantially. 2010 was a little bit sideways. 2011 was pretty dreadful because we had the Eurozone crisis, a lot of volatility. And a lot of mums and dads who got burnt by the GFC weren't even back into the market during those times. So they'd missed a substantial part of the rebound, saw the volatility in the Eurozone, thought, here we go again. And it wasn't until, for many, until midway through 2012 that they started to sneak back into the market. And more recently, sort of into 2014, certainly a lot more people getting back in. I guess the question for them is, what parameters are they going to use to get back out? So we need to think about what our options are when the market risk deteriorates. So what are our exit rules? Well, when market risk can change from one level to the other, in your trading plan, there's some suggestions about how to reduce your exposure, your value at risk. Now, there's a couple of ways that you can do that. You can, first of all, look to trail some stops. So if you're looking to trail some stops, that in itself will reduce your value at risk. However, another way of reducing some of your value at risk is to sell a portion of your existing positions. So you might have made a little bit of money along the way. You realise that market risks or market conditions are deteriorating. So taking a little bit of money off the table is one way of doing it as well. So again, that's just withdrawing some capital from the market because you understand that the driving conditions, so to speak, are changing. So they're two different ways, and we'll discuss these as we go through on Beyond Charts as well. One of the things that I think you really need to think about is your medium to longer term goals by being invested in the market. And as medium to longer term investors, the end goal for us is to get some capital growth happening in our portfolios. We might get some dividends along the way. That's not the sole purpose. We really want to grow our capital over a number of years and make sure that we're out of the markets when those conditions dictate. So from that point of view, if you think about trying to extract the absolute maximum from every single trade that you're in, it's difficult for a lot of people to have the faith that the stocks that they're in are going to hold up during volatile markets. So when a market goes from low risk to moderate or moderate into high risk, it's difficult for people to imagine those stocks that they're in are holding up and going on to become home runs. Now, there's lots of examples of stocks over the last, not just the last 2 or 3 years, but the last 5 years, the last 10 years, where stocks have actually continued to move quite strongly in an upward direction despite market conditions deteriorating. So whilst the market risk models that we've got suggest, and they give us clues as to what's happening in the overall market, and whilst there is behind that the intent for us to manage our value at risk, counter to that, we also need to try and understand that we're never going to get any of those really big trades. They're never ever going to eventuate if we raise our stops up too tight. So it's a little bit counterintuitive. Whilst we're being mindful that the risk in the market is increasing, if we are fearful and we raise our stops too much, then we're almost guaranteeing that we're going to be stopped out. Okay, now if that's the case, then those stocks like Ramsay and CSL, there's lots of other ones along the way that that we can go through. MTU, G8 Education, Blackmores of late, that you're never ever going to allow those trades, which are going to be your best trades, to occur. Now, if you think about it, you'll probably all sit back over in years to come and you'll reflect on some of your best trades. And for most of you, if you follow your rules and don't strangle your trades, you're going to find that you have some fantastic results along the way. And they're the ones that you'll be talking about, and they're the ones that will be making all the difference to your portfolios. The trouble with that is you don't know which one of the trades in your portfolio right now, right at this point in time, is going to be a home run. How many of you might have the next Ramsay Health Care in your portfolio, your next CSL? You just don't know that. You only ever know that in hindsight, and that's where trade management is really, really important. So, the other thing to think about is if you're trying to reduce your value at risk and you tighten your stops, how often has it happened where you've actually almost forced yourself to be stopped out of a trade only for the market to recover and move in the appropriate direction, and your stock takes off, leaving you behind because you've choked it. You've got so close to it for fear of being stopped out that you've really sabotaged your trade. And so I personally believe that we need to think about what our end goal is, what the intent is, and keep that forefront of our mind. And that is a very counterintuitive type of thing to do, because you're only going to get those longer term, those bigger results by not being risk averse, but almost by being risk seeking. It sounds a little bit unusual, but I think it's certainly something worth considering and having in the back of your mind. So let's go and have a look at Beyond Charts now and look at some examples. So what I've done here, one thing that you can do on Beyond Charts is you can actually split the screen. And what I've brought up here is on the top half of the screen is just the XJO. So this is our ASX 200. And what I've done is I've just taken the indicator off the bottom half of it, the stochastic, because it was taking up space on my chart. But what I've left is the little market risk imprints along the way. So you can see when market risk through this period was moderate risk market. Then we went into low risk, moderate, high risk, very high risk, back to moderate, low, etc. along the way. What I've done is I've gone back in time, a little bit like going back into the future with Michael J. Fox, and I've picked out an example of Woolworths when Woolworths was a stock that was performing really, really well. Now, what I've done is I've gone back in time to a point back in 2000. It's that long ago. That's probably the last time when Woolies was a really, a stock that was powering along the right way and doing all things good by way of a technical nature. And what I've done is I've been very, very conservative in terms of plucking out an entry which would meet our existing trading rules. So what I'm looking for is a trough that has formed at or above the second from last peak, exhibiting good strong price action, etc., and looking for an entry point at the same time checking out the market risk conditions back in 2000 and making sure that we're in either somewhere between a moderate risk or a low risk type of market when you'd be looking to have certainly a reasonable amount of capital in the markets and looking for opportunities. So on that particular occasion, a trade entry way back on the 20th of October in 2000, and our market risk at the time was moderate. So very feasible for you to go through and look at an opportunity like this with Woolworths and adding that to your portfolio. And back then, obviously, Woolies would have paid a dividend as well. So for the longer term investors, that would have just been a little bit of cream along the way. Now, as time goes by, and this you need to remember that this market risk chart is currently, using a daily price chart. Okay, and this is something that we'll be talking about at the Academy, different market risk models that you might like to apply to your own portfolio to keep it simple. Certainly after the Academy, we'll bring some of those learnings and some of those teachings back home as well. But certainly those that there will get the first benefit of that. So what you'll see over a period of time is that whilst we get into our Woolworths trade on the basis of a weekly setup, over a period of time our market risk actually improves and we go through to low market risk. Then over a period of time we go into moderate market risk and then into high and then into very high. Now very high, we're using a 20% market risk multiplier. So 20% of your 15, that's a fifth of that. So that's saying you can only have around about 3% total value at risk in the market. Now, traditionally, if you were going to reduce value at risk, you're going to be saying to yourself, well, I either need to do one of two things. I either need to tighten up my stops, or alternatively, I need to take some profits along the way. So if we've just got into Woolies on October of 2000, and then in, let's go forward, then in December of 2000, we're moving into very high risk territory. So let's go forward to December on our Woolworths chart of 2000. So we're in October at the moment, so we're on the bottom chart, and we're moving into December. Okay, so Friday, December the 22nd, and here's Thursday, December the 21st. Our market risk indicator is telling us that we're in very high market risk conditions. During that time, we've gone from moderate to low to moderate to high to very high. And each time this changes, we're starting to think, oh, okay, what does that mean for my portfolio? What should I be doing? Should I be trailing my stops? How close do I trail my stops? Maybe I shouldn't trail my stops. Maybe I should just take half my profit. I don't have any profit on the trade. What should I do? I don't know what to do. All these sounds, all that your mind talking to yourself and leaving you in a state of limbo. So, if we are wanting Woolworths to go on to become one of those trades, we don't really have a say in the final outcome. All we can do is treat the trade exactly the same as we would any other trade. Now, what's going to happen if the market really falls over and starts going the wrong way, like in the GFC or like in 2011 with the Eurozone crisis? If the market really falls over, then what's going to happen is it's going to drag a whole lot of stocks with it. Now, at this point in time, whilst our market has gone from a low-risk market down into a very, very high-risk market, what's happened with Woolies? It's continued from our entry point to move in an upward direction. So this stock in itself is exhibiting high relative strength. Okay, it's outperforming the market and its own performance. Look at all the white candles compared to what the market was doing. So this is a really, really strong sign that you're onto a good stock. As the market's deteriorated, certainly Woolworths gets affected a little bit and its price does come back a little bit over the course of the next couple of weeks. Not a huge amount. But again, remembering that if our our exit rules to get out of a trade are simply when price closes below its trailing 3 ATR, we need to exit. Now remember, that's once our trailing 3 ATR has come up and passed our initial protective stop that we first set up. And you'll see that as Woolies progresses, that it's still well clear of its trailing 3 ATR. So let's fast forward a little bit and see what happens with the market into the future. So you'll see that in March of 2001, so the same, around about, that's beginning of 2001. So we're just clicking over into 2001 in January. 3 months later, we're down into extremely high risk again. So that's March 2001. So let's go to March 2001 on the bottom, February, and we're into March. Pretty much the same time frame now. See what's happened again. The market, whilst it's right down in extremely high risk territory, Woolworths doesn't seem to know what's going on with the rest of the market. You've got a stock here that is ignoring what's going on with the rest of the market. Now, thank goodness we chose not to tighten up our stops. Otherwise, we may well have found that through here we got stopped out and frightened of, re-entering the market. Let's keep going and see what happens. 2001. In September time, 2001. Wow, market really sells off very, very hard. Extreme risk territory again. So let's go forward to September of 2001. So here we are. That's the 7th, that's 14th. So that's the end of the week on Friday the 21st of September 2001. So let's go through to... There we go. So we are in extreme risk territory, and Woolworths won't have anything to do with it. Again, a stock showing really good relative strength. So again, keeping an eye on what our market risk is saying. Okay, yes, market risk is deteriorating. Okay, yes, we need to be mindful of our portfolios. But you know what? That's what our trailing stop is designed to do. It's designed to keep us in the trade, allowing it enough room to do what it needs to do, because we don't know where this is going to end up. This could go to the moon. We just don't know whether it's going to happen or not. And so what we need to do to get those bigger returns is we need to be, rather than risk averse and tightening of stops, we actually need to be risk seeking, which is a really counterintuitive concept. So when did it all end for Woolworths? Well, we went from 2001 all the way through to when price finally closed below the trailing 3 ATR in July of 2002. Well, I wonder what happened with market risk then. July of 2002. Let's go forward. So July, April, May, there we go. So we're now up into June, July the 19th. There. So on this particular occasion, it did actually follow the market down. The market started to move down over a period of time, lots of black candles in the market, and eventually that was enough to drag Woolworths down as well, and that's the end of our trade. So we ended up getting out at $11.78 with an initial entry price back above this. This is the medium-term peak that we were getting in there. The high was at 7.13, so you would have been getting in around about 7.15 on the break of that peak. So 7.15 through to a close here of $11.70, a nice return in about 18 months' time. And we didn't need to worry about all the different market risk changes occurring over that time. So hopefully that sort of makes sense to the importance of just sticking to your trade plan and managing your trade along the way. So that's just one example. Let's go through and have a look at some other ones. This is a more recent one. This is one of a stock down the bottom here, Auckland's International Airport. Now again, using exactly our very conservative trade setup parameters, looking for a stock where the last trough that is formed is at or above the second from last peak, so we're being ultra conservative, just common sense, bread and butter, black and white type of investing decisions, keeping it really, really simple. Plucking out a day in which or a week that our trade was triggered. Now in this case, we're waiting for price to go past our last medium-term peak, which it did on Friday, or the week of Friday, the 24th of January. Now, at that particular time, our market risk condition, we were in moderate market risk. So not in high market risk at that time, but moderate. And if we had room in our portfolio, certainly we could be looking for another entry. Certainly, any stock that comes up on our scan is going to be one that's been outperforming the index for a period of time. That's one of the requirements. All right, so we get into Auckland's airport. We've got our initial protective stop set up. Once our 3 ATR comes up above our initial protective stop, then we just use that 3 ATR to manage the trade with. So as price goes on further and further and further, price recovers on our index, and we go back to a low risk market at the beginning of 2014. Eventually, however, things start to change, and our moderate low market risk starts to move very, very quickly. And you might remember in September of last year, we moved into high risk, very high risk, and then extreme. The market had a big sell-off. Look at all the black candles. So that's in September of 2014. Now, you might know along the way here, during August, September of last year, that our price of this particular stock got very close to our 3 ATR. In fact, it looks like it closed below it. But our rule says when price closes below the trailing 3 ATR, then we get out. So on this particular day here, the close is at 332. You can see that there. The value of our little green line, our trailing ATR, is $3.31, or $3.31.7 if you want to get really technical about it. So is $3.32 below $3.31.7? No, it's not. Okay. So we continue for another week, and the following week you'll see that price is well clear. Now it's 338, well above our 332, and from then on price never looks back, and we're still in the trade today. So last closing price was at $4.64. We got into a trade on the break of our medium-term peak back here at $3.44. So we're up about $1.30 on a $3.44 stock. So it's about a 30-odd% return in, what's that, about 18 months. That's a pretty handy return, and yet during that time we had that horrible move on the broader market throughout September of last year. Market recovered pretty quickly and then started to roll over again. And yet all the time while this was happening, going from moderate down into very high and extreme, back up to moderate, very high risk, all through that time, this stock continued to hold its own, held up well, and continued to move onwards and upwards. So that's just another example of when market conditions change, that being faithful to your trading plan. And if the worst comes to worst and the market does drag your stock down to the downward side, well, you've got your protective stops in there in any case. And so you're not going to lose any more than that unless you choose to ignore your protective stops. And you wouldn't be in the Elite Traders Club if you chose to ignore your protective stops. That's what they're there for, protection of capital. Here's a classic example. This is one, Ramsay Health Care. This has been an outstanding stock for many, many years. And this is the sort of thing that even in 2012, the 14th of December, just prior to the end of the year, you can see 100% market risk rating. We're in a low market risk time. So again, being ultra conservative, looking for our trade setups where we have a trough that is formed at or above the second from last peak. Ultra conservative. Okay, keeping things really, really simple. So getting into the trade towards the end of 2012. Now you can see our market finishes off the year really, really well. Santa Claus rally into beginning of 2013, and we stay in a good market risk for a long period of time. Then eventually in the middle of 2013, we get to a point where we are very high and extreme once again. So let's go forward and have a look at those timelines. So extreme, we are in 1st of July 2013. What's happened with Ramsay? Well, as our trailing stop comes up, we just continue to follow along with that. July of 2013, May, June, and there we go. That's the end of the first week in July. Now, clearly at this particular point, look what's happened to the market. The market has sold off very, very heavily, and yet this stock is still holding up very, very well. A little bit further, as the market starts to recover and move towards the towards the upside, we go into more of a moderate market risk and even into a low market risk eventually. Even at that point there through August, which is the 8th month, isn't it interesting that whilst the market was recovering, Ramsay during this time, it was just having a bit of a pause. It had done pretty well previously and was just having a little bit of a rest through here. It's still well clear of the trailing 3 ATR. And our market continues to move onwards and upwards, eventually moving into high and very high risk in the beginning of 2014. Well, let's go to the beginning of 2014 and see how Ramsay's held up during those exact same time. So the beginning of 2014, February 2014, let's go forward to the same time. February 2014, end of January, beginning of February. So that's the end of January. It's a bit hard to see up there, but we're starting to get into very high risk territory mode. During exactly the same time, our Ramsay stock was still well clear of its trailing 3 ATR. Now, entering that stock, we were getting in at around about $20. Well, at this particular point in time, when the market's really selling off and we're in very high risk, the market's giving back a whole lot. Now, all you had to do with your Ramsay stock is just give it its rein. You're already well in profit. This stock owes you absolutely nothing, but you've been rewarded by just following your rules and maintaining your trailing stop, which is giving it enough room to move up and down without strangling it. We have no way through any of this have we crammed and jammed or anything like that. And as a result, we've been able to benefit nicely right up to this point in time. Worst case scenarios, we get stopped out at around $40. We've still made 100% on the outcome of the trade. So as time goes by, we've all lived through this. We've seen market conditions change. We get up towards the September of last year where the market just dipped down. It looked really, really terrible. A lot of stocks on our market got belted during that particular time. Again, this is during 2000 and at this time September. So what happened to Ramsay during that time? Yeah, look, it had a little bit of a pullback. You know, that's over a couple of probably a couple of months. It's moved to the downward side from about $55 back down to about $50. So probably about 10% from its absolute highs. The market's gone from about 5,700 down to around about 5,100. So it's come off a fair way as well. Market recovers to the upside, and at the same time, so does Ramsay, and it keeps going up and up and up. Now, it's only just recently, a couple of weeks ago, closed below its trailing 3 ATR. So its trailing 3 ATR was at 61.28. It closed on that day at $60.57. So you were getting into Ramsay at around about $20 odd and getting out at around about $60 eventually. So that's all through different levels of market risk. So I think it just goes to show that whilst we have conditions changing all the time, that when we're in those higher levels of market risk and the market really is rolling over, just continue to monitor your positions. You've got stops in there. The worst thing that can happen is that eventually you'll be stopped out. But if you go cramming and jamming and raising your protective stops and being really, really risk averse, there is no way that your portfolio is ever going to have a Ramsay Health Care in it, or an Auckland's Airport, we don't know where that might end up, or a Woolworths that rewards you at the right times. Eventually all good things come to an end, like it has on Ramsay Health Care. Other stocks like MTU, G8 Education, these are stocks that mums and dads out there don't know about, but your relative strength scans help to find those. So certainly I hope that helps in terms of some methodology for you to think about in terms of what to do when those market risk conditions change. Certainly as you enter into high, very high and extreme, don't go adding new positions to your portfolio. The market's telling you it's not conducive. But hang on to your current stocks, continue to manage them with a trailing stop. Don't strangle them, because if the market recovers, you'll find that those stocks move up very strongly. You will notice of lately, those of you who have been in any Australian stocks that have been holding up relatively well, that if the market starts to move back in the right direction, that those stocks will start to move up very, very quickly. Certainly in the US, there's been lots and lots of examples. They certainly haven't had as many market risk changes as what the Australian market has had. So hopefully you've been able to benefit from that market over the last couple of years. So I think what we might do now is just on that, we've had a bit of a look at some examples there on Beyond Charts. So again, with your portfolio management, the best things in life are the simplest things. So keep it simple. Understand that you must use protective stops. You must know your exits, okay? And you must absolutely follow your exit rules. So if your protective stops or your stocks that you're in, if they close below those trailing ATRs, then you must get out. That's the rule. Give your stocks plenty of space, because if the market does recover, you're going to be rewarded. We don't know which of our stocks is ever going to be a Ramsay Health Care. You might be sitting on one or two of them in your portfolio now. Absolutely, good trades take time to develop. That Ramsay trade as an example, and there are other ones out there. You've probably got some of them, benefited from some of them over the years. You know, you don't talk about your trades that you were in for 3 months and you made 20 or 30%. Okay, these are the trades that you've been in for 6 months, 12 months, 18 months, 2 years or more that really make a massive difference to your portfolio. So, and I think the other summary point there is that good trade management, it is counterintuitive, and to get those running trades, the ones that are going to go on and deliver you good profits, you do have to have a mindset that is more risk-seeking than risk-averting. Okay, so hopefully that's helped. If you need any further information about that, you've got the guys here at the Elite Traders Club to give you a hand, but happy to talk you through any of those concepts that we've gone through today. Well, that's it from me in terms of a live session this week. We'll be recording on Friday, just back from his break, so I look forward to sitting in with him for the macroeconomics session on Friday. But other than that, our next live session is on Monday morning at 9 a.m. So enjoy the time between now and then, and we'll catch up with you on Monday. Bye for now.